We're here in studio with Charles Dossey, the CEO of dYdX Foundation, to really talk about all things about really the crypto ecosystem on when it comes to derivatives. Charles, welcome on the show.
Thanks for having me. Great to be here.
Charles, let's kick it off. Really, there's obviously a lot of noise around Bitcoin derivatives, crypto derivatives. Can you maybe share with our audience what is really on a practical level the difference you see with crypto derivatives on centralized exchanges and those on decentralized exchanges like yourself?
Absolutely. Maybe for starting, we can just look a little bit how the markets are organized in the equity world and trying to illustrate it towards the crypto markets after that. So today, if you want to buy, for example, an EMA stock, you can buy the EMA stock directly and get the custody of it. But there is also a market where for any stocks and equity in general, you can get what we call a synthetic exposure to it. And you can decide to go long, to go short, and to express your market with much more, I would say, granularity. So this is what we call the derivative market. The derivative market in crypto works exactly the same as the equity market. So either you buy a Bitcoin on an Ethereum or a portion of a Bitcoin and you own it on your own wallet, but you can also decide to express your opinion on the market without owning the Bitcoin itself, but getting essentially a future contract, a derivative futures contract. And this market is very important. This is where the price discovery of the whole crypto market is happening. Crypto derivatives are 10 times bigger than crypto spot. This is where people need to pay a lot of attention. And at dYdX, we specialize in crypto derivative as a decentralized exchange. The market of crypto derivatives is evolving. It started back in 2018 in Hong Kong with BitMEX, where the team of BitMEX started to kind of popularize what we call the perpetuals. So instead of having a futures contract at 30 days, 60 days, or 90 days expiry.
There is a maturity date.
Exactly. On perpetuals, they don't have essentially maturity dates. So they update themselves every hour. So you can hold your position for a much longer time, and you don't have to consider the complexity of a pricing with a 30 days maturity or 90 days maturity.
So let me just discuss this point specifically, because dYdX is actually differentiated from other decentralized exchanges when it comes to perpetual contracts. So to what extent are you seeing a high demand on these type of contracts?
It's a very natural thing in the crypto market in general. There is 10 times more demand for derivatives than there is for spot in general. And it's a market, crypto derivative is more towards institutionals and I would say prosumers, traders which are already very experimented and which can basically build complex strategies of trading. And in this case, they will want to get essentially leverage the tools of derivative to express themselves on the market. The pivot away from centralized exchanges for derivative to decentralized exchanges is only starting. So just to get back a little bit to the infrastructure of this crypto market, most of the time people started trading on spot crypto, buying Ethereum, Bitcoin, you name it. And eventually the market started to mature and there was the birth of this derivative market, which is now 10 times bigger than the spot market. So usually people started on centralized trading venues, think of Binance, Coinbase, or some others. But now there is a big trend of people migrating away from centralized exchanges for crypto derivative to decentralized exchanges, such as dYdX.
But then even, Charles, I agree that the crypto derivative market is 10x the data spot markets, but when it comes to decentralized exchange in the space, it's still a very small percentage. It's less than 10% of crypto derivative trading happens on decentralized exchanges. What do you think will be the catalyst for us to see more activity happen, not only on centralized exchange on derivatives, but actually on decentralized exchanges when it comes to your asset class?
That's a great question, and you're definitely on spot. If we look at the migration away from centralized exchanges to decentralized exchanges, the spot market is ahead of derivative market. Today, between 10 to 15% of the spot trading globally is on decentralized exchanges. For derivatives, this transition is still happening right now. We estimate between 2 to 3% of crypto derivative trading happening on-chain today. So there is really a big growth potential for the market to migrate. The catalyst will be better experience, essentially. That's very important. Today, when you trade on a centralized exchange, everything is simple. It's a centralized database. You've got like counterparts. You're trading against whoever is trading there. On decentralized, it brings more transparency. It brings more security. But to be honest, the experience is a little bit more complex. So the product has to essentially improve. But there is also, I think, for DeFi, a challenge for the industry overall is to define products which are unique to DeFi and which you will only be able to find on DeFi venues. So, for example, the way the spot market has migrated away from centralized exchanges to Uniswap, for example. Uniswap came with the potential to list any asset, anytime. And for the derivative market, we need to progress in this direction to create an unfair advantage for decentralized exchange venues for derivative and creating an acceleration of the migration away from centralized to decentralized derivative trading.
But when it comes to, for example, best practices, you obviously believe a lot of the market will go trade on the venues that have these best practices. But could you share maybe more with our audience, who's your typical customer right now, to the extent that you guys have that data available, but who's your typical customer that is trading on decentralized exchanges today?
So traders on decentralized exchanges are, for the most part, automatic traders. Yep. So they're not trading with a user interface. They're not clicking on buttons. For the most part, they are using API. That's very important. So they're basically trading with machines. The advantage for API traders on decentralized exchanges is that they can essentially look at the order book and how the order book leaves the market. If you trade on a centralized venue, the order book is essentially a black box. So your algorithm or your traders just essentially listen to what comes their way, but they cannot really understand why this song is coming this way. When you go on decentralized exchanges, the order book is totally transparent. So you can start to teach machines, you can start to teach AI to understand how things are reacting. And maybe if Henri's P&L is better, I can essentially ask my AI to say, okay, try to learn how Henri is building his strategy so I can try to possibly beat him at some point.
Copy the return profile.
Copy or learn from it. So I think that's a very important way. The decentralized traders are, for the most part, at least in derivative, institutional, they trade with API. So mostly they're trading this way. And they are market makers, they are large institutional, there are also a group of people, a subset of users which are doing the arbitrage between CeFi and DeFi exchanges, because there is always a price difference. So the same way, back in the days, there was what we call a kimchi premium between the price of Bitcoin in Korea and the rest of the world. There is also some kind of premium between the price, for example, of the Bitcoin future, PERP, on centralized exchanges versus decentralized exchanges. So there is always opportunity, but all of this is happening at high frequency. It's tens of thousands of orders per second, where people are listening to the whole marketplace and trying to make the best of the market.
So let me talk about the future of decentralized exchanges. 10 years from today, with everything that is happening in the industry today, where do you see the future of decentralized exchanges?
That's a very tough question, May, but I will give it a try. DeFi is reinventing money. It's moving money away from the old legacy infrastructure to the internet. So we are making and building together with central banks and crypto innovators and software innovators the internet money. So I think it looks always uncertain, and we are thinking it's uncertain times for crypto. I think it's uncertain timing. Crypto is here to stay, and crypto is evolving. The signals from we have around the industry, not at the core of crypto, but around crypto, is that people are embracing the technology, embracing the concept. We see stable coins progressing very, very quickly in multiple regions of the world. We see central banks in every country on earth working and deploying CBDCs, central bank digital currencies, leveraging crypto, essentially technology. So crypto will be everywhere, DeFi will be everywhere. And I think the same way the internet started with a lot of question marks, people thinking it's too slow, it's very expensive, I need to be behind my desk to play with the internet. Fast forward, internet is in our pocket. We are paying with our phones, and the internet is all over us. So DeFi in 10 years will be ubiquitous. You will not think you're using DeFi. It will just be a new generation of finance, which was called DeFi at some point. And people will not think too much, is it decentralized or decentralized? It will just be the most efficient, the fastest way, the most convenient way which will play and which will win this game. And I believe we are building right now, experimenting, sometimes having great wins, sometimes co-building things which are a little bit shaky. But these innovations will bring us to the new generation of finance. So it's very exciting, and that's why we spend so much time on it, and that's why some of the best talents in finance are essentially rushing into our industry.
There's definitely, like you mentioned, it's a bit like e-commerce that has now just became commerce, and that exactly the same thing may happen with DeFi. But one thing I want to touch upon is really the entry of institutional players. Of course, now we're seeing gradually a lot of these institutional players enter the crypto space, especially via centralized exchanges. When you talk to CEOs of financial institutions, bank, regulator, central bankers, you mentioned, What is the main challenge they're telling you that they have as they want to enter the DeFi space, or at least interact with it?
The biggest challenge, number one challenge for them is essentially regulations. Yeah. Understanding how their regulator will perceive them being part of some DeFi protocol or DeFi trading flow. Second part is infrastructure. How do they get ready to essentially trade on DeFi infrastructure? Your API, your connectivity is not the same. So the way I approach this with conversations we have should be with regulators or hedge funds or family offices. Number one is you need to start the learning curve. You don't want to be late to the party. If DeFi is not clear in your mind, you need to start learning this process today, making sure your engineers, your traders are familiar, making sure you have the infrastructure. Second part is work with your general counsel, work with your regulators to make them understand what you're exploring and how to make it the right way. And then the last point is pick where you want to do DeFi. There is many different corners in the internet, and some of them are a little bit more dark than others. It's exactly the same in DeFi. Some venues are decentralized venues, but they are making best effort to make sure that there is AML, there is good market practices, that there is everything the regulator might want to ask. And I think this is maybe my last point here. We have a responsibility as DeFi practitioners is to stay engaged with regulators and not claiming that DeFi is good. We should be demonstrating. Because if you look in the details of what the regulators want to achieve, and if you look in the details of what DeFi brings to the market, to the participants, but also to the regulators, there is a lot of overlaps. It's two worlds which eventually will meet. DeFi brings transparency of the marketplace. When you trade on a centralized exchange, you take the assumption that the marketplace and the order book is healthy. I have no ID myself. If you have an ID, that's good for you, but I think many people take assumptions. So if you go in DeFi, it's totally transparent. So we bring transparency on the marketplace. We bring safety of the asset. When you trade on DeFi, you essentially have the full custody of the asset. So if one company collapses, like
you don't have exposure.
You don't have exposure
to this company. So let me ask you one thing. Are the requirements of retail investors really that different from requirements of institutional investors? And aside from regulations and the regulatory environment, I'm talking about the certain products and services that they require. To what extent are they different between retail and institutional investors?
That's a great question, May. The retail investors want the memes. They want the latest assets, which are like the flavor of the month. So they want high velocity of listings, which DeFi can provide. The retail traders want to trade on mobile phone. So they will complain if the latest feature is not available on their iPhone a week after or their Android phone. So they really want the convenience. They want to be able to start a trade on their desktop and end a trade on their mobile phone, maybe on their way back home. The institutionals will want like clarity and visibility. So they want to know when is your next upgrade, so they can prepare their engineers. They want to have like a level of certainty of the performance of the platform, so they can essentially take a position or start to trade for 30, 60, 90 days. So it's very, very, very different type of demands, but eventually they meet on the marketplace. Yeah. So that's not easy in the kitchen, I would say, but that's a very, very exciting journey.
But talking about the kitchen as we close off the interview in 30 seconds, really, like obviously you've led many organizations in your career. Now you're a CEO of a crypto decentralized foundation. How is it actually being a CEO of a foundation different from other organizations you've led in the past?
So I've been working for Consensus, the company behind MetaMask. I've been working for the Hong Kong government before as a head of fintech. Working for a foundation is, you're not after a P&L exactly, right? You're after the growing an ecosystem and trying to make sure that this ecosystem is going in the right direction and essentially capture mind share and growth. So my challenges every morning is do I have enough talent and the right talent in the ecosystem? My challenges are the governance, because every token holder of dYdX can express their opinion and can decide to launch a vote. So is this governance having enough context? Do they go in the right directions? Are they getting lost in discourse? But it's a lot about mindshare, it's a lot about governance velocity, and it's a lot about talents, like any CEO, I suppose.
Thank you so much, Charles, for being with us today in Crypto Weekly, dYdX Foundation CEO. Thank you so much.
Thank you.